Identity theft, the holiday gift that keeps on taking. Investor Beat starts now. Thanks for watching. I'm Allison Southwick. Yesterday, we saw a jump in the market following Bernanke's taper announcement to reduce stimulus, but today we have a more muted response, and the market is just hanging out around breaking even. Joining me in studio is Jason Moser and David Hanson. So let's get to our top story. Target announced today a holiday data breach that has compromised 40 million credit and debit cards belonging to people who shopped at brick-and-mortar locations between November 27 and December 15. So only some of the most busy shopping days of the year. What do we know so far?
I was going to say, I mean, you keyed in a lot of the important points there, and it's important to note that this is for customers that shopped only in the physical stores. If you were online, that doesn't matter. If you went to a physical store and paid in cash, that obviously doesn't matter. But with that said, 40 million accounts is a big sounding number. I mean, it is a big number. And so I think at this point, that's about all we know. I mean, they're trying to sort of figure out exactly how this started. They say that they communicated this to the public immediately when they found out, right after they found out about it. I think that's key here. We need to make sure that's the case, because if they've known something about this for a little while before they actually let the cat out of the bag, I think that is going to be a real PR nightmare for them.
Yeah, so 40 million does sound like a big number. It is a big number. But an even bigger number is when we go into the way back machine to 2007, when TJ Maxx had about 90 million cards compromised in a data breach. So what can we learn from that? Was there any fallout for investors? Obviously a huge problem for consumers, but was there anything for investors there?
No long-term fallout. It's a bad headline, 40 million, however many million. It doesn't matter how many there are. Anytime there's something like that in the headlines, it doesn't feel good as a company, but as an investor, I don't think you should pay too much attention to it. You look at TJX, absolutely crushing the market since then. It didn't even matter. Maybe it was a one-day impact, but over the long term, investors don't need to worry about this kind of stuff.
So rumors are spreading, and I'm helping spread them, that this could be an inside job, which, as we talk about PR nightmare, that could really escalate a PR nightmare. What's your advice for Target as far as getting ahead of this?
Wow, I think just keep on doing what you're doing. You know, I checked on the website to make sure that they had this front and center. I think they actually could make it a little bit more obvious. I checked their Facebook page, Twitter, so they are getting it out there to the proper channels. And then from there, I think it's really just a matter, I think that David struck on something very important there. As investors, there's not much you can really do or say about this. It's one of those risks that's just inherent in our society today with electronic payments and brick and mortar retail. I think that really what Target needs to focus on, the bigger problem they're facing, is this move towards e-commerce, which, retail, it's only about 6% of the retail environment today, but it's moving that way slowly but surely. And just to put this into context, if you compare Target to Amazon now, they both bring in about the same amount of money each year, around $70 billion. But when you look at the market capitalizations of the company, Target's at around $40 billion, Amazon is at $180 billion. So the market knows something. It knows, I think, what we've been talking a lot about lately, and it's this move to e-commerce that they really need to keep their eye on.
All right, let's move on and look at some of the day's movers and shakers. Darden Restaurants took a hit today after announcing earnings. Overall sales were up, but Red Lobster in particular didn't fare so well, and the company is looking to get rid of the concept. So Jason, I think I've gotten a better idea here. Instead of selling Red Lobster, they rename it Cheddar Biscuits, and they only sell, wait for it, cheddar biscuits. What do you think?
I mean, it sounds to me like that's probably the best case scenario for them, because I don't know that there's much of a proposition where Red Lobster is concerned. I may offend someone out there. I don't know. I grew up on the coast of South Carolina, so I'm particular when it comes to seafood. But when you look at the numbers, I mean, Red Lobster accounts for about 30% of Darden's sales. But the same store sales and the margins that come with this business just keep dragging down the business. So it makes perfect sense for them to unload this in one way or another, because it's just not really, it's not something they can look forward to. That doesn't solve everything for them, though. And so I think this is just one piece of really a bigger puzzle that they're going to have to try to put together here for the coming years.
Rite Aid is down today after announcing earnings. Even though profit was up 16% and same-store sales were up 2.3%, the stock took a hit because of disappointing forward guidance. So David, why the rough road ahead? Is it a Rite Aid problem, or is it a problem for CVS, Walgreens, Rite Aid, other drugstores?
Historically, it's been more of a Rite Aid problem, so maybe you'd lead in that way. But let's put the 10% drop in perspective. The stock is up 4x over the last year or so. I mean, it's been a beast over the last year, so 10%, it hurts. But it's had a rough history. They're trying to turn the business around. They've been kind of this third place laggard for so long. So maybe this is just a bump in the road for Rite Aid.
Oracle is up today after beating analyst expectations for second quarter earnings. The company has been focused on gaining market share in the cloud, and it seems to be paying off. Now, Jason, when we talk about the cloud for Oracle, what are we talking about here?
Well, we're talking about just that. What all these companies are doing is pushing that information technology, that management out into the cloud, so to speak, to make it more accessible from more locations. You have companies everywhere from Amazon to Rackspace to Salesforce and Oracle all fighting for this. And I think that what has dragged on Oracle for a while here is just it's a huge company to begin with, and their top line sales revenue, it's just basically been flat. It's just kind of stagnant here the past couple of years. But what we saw in this announcement was an increase of 35% in cloud-related bookings. Now that shows that they are focusing on that big market opportunity that's coming down the pipe here. That's important because we know they're not just kind of resting on their laurels, and I think that's what has the market excited today.
Realty Income, one of the nation's largest REITs, is down today. Their copyrighted tagline is the monthly dividend company. So that sounds like something pretty dependable. David, what happened?
Yeah, not a huge concern with the actual business here. I don't think the dividend is in danger of being drastically cut. But when we talk about interest rates going up, the Fed potentially tapering, dividend stocks may get hit a little bit more as investors can kind of move and find incremental yield in fixed income. It doesn't make as much sense to hold dividend stocks. So this is more of a macro deal for Realty Income than a business deal.
So other REITs were down today, or?
Yeah, it's kind of across the board.
All right, so that's going to do it for today. Let's take a look at one stock on your radar. Jason?
Well, CarMax is announcing earnings tomorrow, and I think everybody knows CarMax is that big sort of auto supercenter that you see on the side of the interstate every once in a while. It's really interesting to see as the economy has sort of bounced back a little bit. You know, some jobs are coming back, housing prices are going up, and people are having a little bit more money. Used cars still represent a great value proposition for folks out there looking to replace their vehicles. And the fact of the matter is that the average age of the vehicle out there today is about 12 years old. I mean, we're just in the midst of a dire. we need to replace a lot of cars out there. And I think that I think that CarMax is going to benefit from people still looking for value. They're the market leader in that used car market. So I'll be interested in that announcement tomorrow.
All right, David, how about you?
I'm watching Nike. They're reporting earnings today, and I know this is a company that Jason follows closely as well. This is a company that I own. Obviously, great brand. It's been doing great, but the stock is at a valuation that puts it at the pricier kind of range of where it's ever been. The one thing that I want to be watching for is the direct-to-consumer sales. How many people are coming to Nike and buying stuff directly from them? If that segment continues to grow, that's a good sign for Nike.
All right, well, before we go, for this year's philanthropy drive, we're raising money to help build schools in Nicaragua with Pencils for Promise. You can learn about how you can join other Fools in supporting a great cause by going to fool.com/give. For Jason Moser and David Hanson, I'm Allison Southwick. Thanks for watching.